Got it.
All right, here we are toward the end of 2021. My good friend Mark Mahaney has written a book, which you can see in the little corner behind him. Here's my copy. Nothing But Net, a basketball reference, but also a reference to where you may have wanted to have your money for at least the past 10 years, maybe longer, as long as Mark's been an analyst, invested in high growth tech companies, specifically internet companies. Isn't that right, Mark?
That's a great setup. And yes, the title of the book, Nothing But Net, the subtitle is 10 Timeless Stock Picking Lessons from One of Wall Street's Top Tech Analysts. Whew, that's a mouthful. But Nothing But Net, that's been my signature email tagline for the last, it's either been that or always online, one of those two for the last 25 years. So it does reference the fact that I'm the oldest and longest lasting internet analyst on the street. So internet, net, internet. But it also reflects my own personal passion for the game of basketball that Tom Carter and I know well and have enjoyed. And it reflects my son's fascination, enthusiasm for playing basketball too. So there's a lot of meaning to the title. But yes, I tried to look back on 25 years of covering internet stocks. And, you know, there's been some big bombs in the internet, but there's been some wonderful stock performance. And I try to draw lessons from both the dramatic winners in the internet space, like the Amazon's up 166,000%, up 166,000% since its IPO, and Netflix up 45,000%, and a bunch of other names like Google and Facebook that became the FANG portfolio. And then I try to draw lessons from those, as well as from the ones that coulda, shoulda, the Yahoos and the eBays that looked like they were going to be the kings of online advertising and online retail and then weren't. And then from some of the big duds like Blue Apron and Groupon. So I tried to draw lessons for those, really for investors. And, you know, Tom, what really kind of inspired me to do this was, part, I just wanted to step back, get a chance to really think about lessons from the sector that I spend day in and day out hyper focused on. I also looked at all of these new investors that were coming into the market during the COVID crisis, and there were something like 15 million new Robinhood accounts started up, and I sort of felt like there really wasn't a good learning guide, you know, get me started guide, like there was 40 years ago with this wonderful book called One Up on Wall Street by Peter Lynch, the famed investor. I just thought that there needed to be something a little bit more recent and modern than that. That was a wonderful book. And finally, I just I wanted to give people confidence to invest, particularly in high growth tech stocks, which I think should be part of a portfolio. And I think that's, if you had that as part of your portfolio, the right ones, you could have had really nice returns. I'm trying to, you know, if you will, help people gain financial independence and to invest. You know, I can't help you with the saving part, but I can help you with the investing part, using some of the guidelines from both some of my big wins as a stock picker, but also some of my biggest blowups and mistakes as a stock picker. So anyway, I wanted to give people, you know, a handy dandy tool or perspective about how to invest in the space. And that's what got me to write the book.
Yeah, well, I've enjoyed it, and I'm glad you wrote it. I, of course, read Peter Lynch's book a long time ago when that came out, and the time was right for something like this, for sure. You know, the value investing, Warren Buffett stuff, you know, is really faded. It's been hard to make money as a value investor. And I think with technology stocks, you know, there's ups, there's downs, and I think for individual investors, they're probably wondering at the most fundamental level, do I just index or do I try to stock pick, right? And so you're saying if you are going to be active with individual stocks, here are the principles that you've used and that you speak with the buy side regularly, the institutional fund managers whose job it is to manage active money, and these are the lessons that you've learned yourself over time, and this is what you impart when you talk to institutional managers, right?
Yeah, that's the setup, Tom. But you know, this book is kind of geared towards the seasoned investor, but probably more so towards the retail investor, the Main Street investor. And I try to draw lessons from what are household names today. You know, Netflix, Amazon, Uber, Spotify, Facebook, Google. So I think it's and DoorDash is in there, Grubhub. So this companies, services that people can relate to. And and again, I start off with a bunch of lessons because we've really had a pretty good run in the equities market, over the last 10 years. And I just try to remind people that investing has always involved risks, and you absolutely will lose money from time to time because you'll pick your share of losers. I did, and I still pick my share of losers. I hate doing it, but I'll have stock calls that just don't work. And that happens. And then you'll also lose money sometimes, even if you pick the best companies and the best management teams, because the market is volatile. You pointed that out. Maybe tech stocks slightly more volatile. But one of the things I really lean into throughout the book is, to rely on fundamentals, because the simple rule I've found, having looked at the most volatile part of the market, or one of the most volatile, probably the most volatile part of the market, is long-term, the market respects fundamentals, and companies that grow their revenue bases, increase the size of their profits, those stocks over time, they go higher. They can be dislocated, for weeks, months, sometimes quarters, not often, but never for, my experience, I'm sure there's some exception, but never for longer than 12 months. And if you find high quality assets, especially if you buy them when they're dislocated, it's really a great way to, I think, make money in the market with part of your portfolio. And let me just cut to the chase a little bit on this. My pitch on the book is, if you're going to remember one thing, please remember DHQ, not DQ. That's Dairy Queen, not that. DHQ. So dislocated high quality companies. And what I all of us, when we invest, we're trying to mitigate two risks. There are always risks. You're trying to mitigate two risks: fundamentals risk and valuation risk. Fundamentals risk is in buying the shares of a company that blows up on a quarter, has a sharp revenue decline, profits get crushed. There's a new competitive risk. They misexecute on a product launch. They misexecute on a geographic market expansion, things like that. That's all fundamental risk. And the way you try to mitigate that risk can never eliminate it, but the way you try to mitigate or minimize that risk is to buy high quality assets. So we'll go through that, but I try to put out a few things that I look for to determine whether a stock is high quality or not. And then on the valuation risk, you're trying to minimize two risks: fundamental risk and valuation risk. And valuation risk, well, one way to do it is buy stocks when they're for sale, i.e. they've been dislocated. That's the way I say it. They've traded off. And I use a rule of thumb of 20 to 30% corrections. There's a lot of judgment calls in there, but I'm just making a point that if you identify the high quality assets, they all get dislocated from time to time. The best stocks, the Apples, the Microsofts, the Teslas, the Amazons, the ones that have really powered the market the last 5 years, they all get dislocated from time to time, and use that as an opportunity to either buy the stock or add to positions. And again, that dislocation, as a quick rule of thumb, is kind of like a 20 or 30% correction. And you've seen it with all the great franchises, all the great high quality names. So that's I hope people will still buy the book, but I'm giving away the key secret, which is hunt for DHQs, dislocated high quality companies.
Yeah, no, I can tell people that are listening in that there's a lot more detail in the book and things that you can learn from, and that Mark's not referring to specifically, including a lot of the ones that didn't go all the way,
yes,
up and to the right, as we say. Let's get into a little bit more. What comes to mind as I'm listening to you is, should people be content to sort of pick, the 2, 3, 4 companies that are large and they know them, well, they use them: Amazon, Netflix, Google, content with those large scale companies, or get tempted into, you covered a bunch of younger companies, newer companies, smaller market caps, a little more volatile. You covered, we could name, your book has, reference to Zulily and Blue Apron and now Stitch Fix. So talk to us about, large established companies that seem to have monopolies or developing pretty near monopolies, versus these other companies that are challengers, we'll say, innovators. Maybe there'll be $1 trillion market cap, maybe not.
Well, I'm hoping to try to find the next Netflix, Amazon, Facebook, Google. Now, I think that Amazon, Facebook, Netflix, Google can all continue to outperform. For the most part, I do talk about sell indicators. You could have stocks that do wonderfully. There, at some point, but at some point you sell the stock. And one of the fundamental things I look for is when revenue growth starts to decelerate significantly, particularly when it kind of dips well below the 20% threshold. To me, that's premium growth. To me, that's really special growth. Like I want an indication of a company that's got unusual growth potential, is a company that can consistently sustain 20% growth. So when companies fade below that, in the book, I go through the history of Priceline, which is a phenomenal stock, best performing stock in the S&P 500 for a decade. And then growth faded below 20%, and the stock, it didn't implode or anything. It just sort of performed in line with the market. And the next candidate of those FANG names, I watch Netflix. I don't think they're too far away from that 20% threshold. And then a little more tactical with the stock when it's got kind of sort of more normal growth. So then I look at some of the newer assets, and I try to look at 4 screens, Tom, when I think about these newer stocks. How can you find the next Amazon? So I look for companies that what I call face large TAMs, or total addressable markets. The bigger the better, because the bigger the market, and especially if you can find companies that are facing really large end markets but have a very low percentage share of that, right, there's a much greater chance that they can sustain premium revenue growth. I look for companies that have got really compelling customer value propositions, and a lot of the innovation in tech has been in consumer tech. Not all of it, but a lot of it has been. So that means that any of us can judge these companies well. That's the Peter Lynch principle. You like the coffee, you buy Dunkin' Donuts, the stock. And, my 14-year-old son, Tom, asked me about what stock to invest in. And I said, I'm not going to tell you which stock to invest in, but I'll start off with the process with you. Which service do you use a lot? And so that, you feel like you can get have a good innate feeling about why other people may like it. And he said DoorDash. And so I said, okay, let's start with DoorDash. So anyway, you decide whether you think that's a compelling value proposition. Is it easier to order meals or maybe groceries or maybe convenience products with DoorDash than from other companies? Like you can answer some of these questions yourself. So I'm looking for companies with really truly compelling value propositions, because I find that customer-centric or consumer-centric companies usually beat out investor-centric companies over time. That, to me, is the lesson from Amazon versus eBay, DoorDash versus Grubhub. Third, I look for companies that are really great at product innovation. Great product innovation creates new market opportunities. And, really good management teams usually tie in with really good product innovation. Again, you're a consumer, you can decide whether you think that the Amazon Fire Phone is really good or not. Turned out not to be so good. But you can also decide whether you think these Amazon Kindle devices, way back when, were really good, or how much better the next iPhone is. So you look for companies that have got a track record of product innovation. And here's one easy out, which is, in finance and investing, Tom, you and I are both know the maxim, past performance is no indicator of future success. Anybody who buys mutual funds or financial products always has that Riot Act read to them. Past performance is no indicator of future success. However, when it comes to product innovation and management teams, I think past performance is an indicator of future success, because companies that show the ability to effectively innovate in 1, 2, or 3 different product areas probably have something in the culture of the management team that allows them to replicate that success. And then the final thing I look for is just really excellent management teams. And I throw a bunch of examples of cases where I thought I saw that pretty clearly, and cases where I thought I pretty clearly did not see that. Because at the end of the day, that's probably the single most important factor. I love to see founder-led companies, companies that are still run by their founders. You look at the biggest wealth creation stocks in the world, they're almost all tech stocks, and they're almost all run, or they were run for 15, 20, 25 years by their founders, whether that was Microsoft, whether that was Amazon, whether that was Apple, Tesla. You can go down that list, and they're almost all founder-led companies, or they were materially run for a long time by founders. So I do prefer to find founder-led companies. Not exclusively, but I do generally have a preference for that. Anyway, those are the 4 things I look for in those high quality names. The total addressable markets, the compelling customer value propositions, really good examples of product innovation, new products that they roll out, which gives you the hint that the management team probably knows how to do this. And then finally, get back to that last thing, the most important one, really the look for signs of really excellent management teams. Excellent management teams can create value where even in tough market conditions.
Right. All right, let's turn directions a little bit, and I don't invest in stocks day in, day out. That's not my job. I'm not an active manager. So when I come at the question, I'm coming at it more of just an average retail investor, let's say. And I'm sure even 5, maybe even 10 years ago, at some point in time, somebody could have said, geez, I don't know, Google's pretty dominant in what it does. How much more can it do? They've got such penetration. So let's just say Google, Amazon, Netflix. Let's just say the cat's out of the bag, and it's a pretty efficient market. Those stocks are pretty efficient. Let's just say that. Let's dig a little bit into the universe and talk about some other names.
Okay.
Shopify is one where we don't drink it, we don't touch it really directly every day as individuals like we do Netflix or we search in Google. Talk to us about Shopify, and then I'll probably ask you about Alibaba as well. I'm just thinking of companies that have probably great potential to scale, or well positioned, but are not FANG and are positioned with really to grow globally and to scale globally.
Well, here would be the hypothetical pitch on Shopify. I mean, it's developed a dramatic market cap on its own through a lot of great growth. And I'm just glancing here. We're doing a market cap now of 170 billion. That's very impressive. They also are one of the most expensive stocks on a price to sales basis, but they've really are wonderful. They are a great derivative or a wonderful play off of the growth of what I sometimes call long tail retail, or direct to consumer brands. You are seeing, there's more evidence that you're seeing the rise of these small mom and pop retailers, online retailers. You usually see them in your Instagram newsfeed, and they in many ways are powered by a Shopify. Shopify has become kind of the online rails for new entrepreneurs. There are 1 million plus businesses on Shopify, each of which generates at less than 10 million a year in sales. So these are relatively small businesses, small, medium-sized businesses. And they're able to sell because Shopify simplifies a lot of things. And consumers seem to be increasingly embracing small independent brands, direct to consumer. They're starting to increasingly follow brands rather than retailers. And if that continues, Shopify is a wonderful derivative play off that. It's got one of the fastest growth outlooks, revenue growth outlooks, north of 40% in the in consumer tech. It's got a sort of a software SaaS type model. Now they're bringing in a lot of new things, but I say software and I say SaaS, and you should think high gross margins, which is what they have, and a lot of revenue visibility. So the business model, I think, is pretty interesting. It's a good, high quality business model. You got a founder-led company. It's embracing a very large TAM, which is kind of global retail, and you stack all that up. That's in the trillions, and they've done a wonderful job in terms of a little harder to tell about the product innovation and the customer value prop. It's just that the number of merchants they have keeps growing. So that's probably a pretty good sign that they're satisfying merchants, that the number of merchants keeps growing and grows strongly, not just modestly, but grows strongly. And so, I think it fits that screen pretty well in terms of being a high quality company. What you've really been waiting for is that D opportunity, that dislocated opportunity for Shopify.
Yeah, on the price. And is Alibaba just too far away? It's in China, and it's probably got a lot of tentacles, probably hard to cover well. How do you think about trying to stay up on their prospects, and how do U.S. buy side managers think about it?
So I don't, I no longer cover Alibaba, though I covered it for many years, and there's a different dynamic, unfortunately, involved with it, which is, you think about big tech regulation here in the U.S. and Western Europe, and Facebook and the issues they're facing at Amazon, Google, Apple, maybe Microsoft. In China, it seems more pronounced, and it seems it seems more arbitrary. I'm saying that from a distance, so I may well be missing things, so I want to be humble about it, but it does seem more arbitrary. And, the last thing investors want is arbitrary regulatory risk. At least, in the US, if we're going to break up companies, the DOJ and, will take years to work through that, which is a good thing, because that's a major decision to break up companies. So anyway, that looks like that could happen much more quickly in a country like China. So anyway, I just think that there's political regulatory risk there that's just greater, and so that's probably out of my zone of comfort in terms of investing. That's there's a large TAM. You had a founder-led company for many years. Jack Ma, I think, is one of the more impressive. I tell his story a little bit in the book. He's one of the more impressive entrepreneurs I see. By the way, he beat Amazon. By the way, he beat eBay. eBay was the Amazon of its time, way back when. So he's taken on big competitors. Alibaba, I thought, always had a pretty compelling value proposition, a lot of great customer, a lot of really good product innovation. It's just the issue has been what appears to be, from my limited perspective, somewhat arbitrary regulatory risk.
Yeah. So you won't cover any of those for the time being. Any of the Chinese?
No.
Yes. Facebook. Here's the way I think I'll try to frame a question. I'm sure you can reframe it. Did management make their product, and I'm talking about the Facebook feed and Instagram, did they make that product unhealthy? Is this in your mind and in the buy side's mind? Has it caused institutional investors to sell? Is that idea caused them to say, I'm thinking about ESG, and it's pretty clear to me that these products have been, mentally and emotionally unhealthy for customers?
Yeah. So I think right now Facebook. I like Facebook as a stock. It's actually one of my favorite stocks for next year.
I know. I realize. I watch you on CNBC. I know.
And I do it because I do it because I think it can fix. I think it can fix a couple of problems. I think it can. There already is an ESG discount in Facebook. It trades at about 20-25% below the multiple of Google, despite the fact that they've got similar growth outlooks. That to me is the ESG discount. And so that's the bad news. But the good news is, well, that's something that's possibly fixable. And the company has done a series of things recently, like moving image recognition features from its software, by introducing features that allow teens and parents of teens greater control over Instagram time, by cutting back on the ability of marketers to target based on political views or religious beliefs. So, they've been tone deaf at times in the past. I think that's a fair criticism of management. They look like they're starting to react. So, all I can do is point that there is an ESG discount on this name. If they can address that, that means there's room for the multiple to go higher. And then I think they've also got these other challenges related to some of these privacy regulations that Apple has been implementing. I think that caused their growth rate to slow down. If they can fix that and come up with successor ways to help marketers target their audiences without violating privacy, that if they can fix that problem, that's another way for the stock to move higher. So I do like Facebook. I think, my own personal view is I think that the criticism about Facebook has just gotten a little too heavy. The way you phrased it is exactly how it was captured in the popular press. To be really specific about it, the Wall Street Journal headline was that Instagram was toxic to teenagers, citing Facebook's internal studies. We don't need to get into it too much now, but if you actually looked at the internal studies, which were made available, the survey results didn't say that Instagram was toxic to teenagers. It said that for about 20% of teenagers who had body image issues, being on Instagram made those body image issues worse. You keep looking at that same slide, and then it showed, well, actually more teenagers with body image issues actually felt better by being on Instagram. And then when all of us should just step back, put our logic caps on and say, the unfortunate reality is that teenagers with body image issues are going to feel worse by a lot of things, like going into schools, like watching most popular TV these days. So I just thought there was the to its credit, Facebook was doing these kind of studies. I don't think any other media outlets were, but to its responsibility, it should have been doing these studies because Facebook is an extremely influential, powerful platform. So anyway, that's my nuanced answer to your question. I don't think when all is said and done, I don't think Facebook and Instagram, I think at the whole, they've been beneficial to most people who use them. But just like any media platform, they can be misused, and they have been misused. And there is a responsibility on a part of people like you and me, i.e. Tom, i.e. parents, to make sure that just like with any other media and with any other thing that our children and teenagers are using, that there's the right adult supervision around.
Right. Very good. Well, I appreciate all that. Well, dislocated. What's dislocated right now? What's high quality growth that's dislocated at the moment? Again, we're into December 2021 right now.
Yeah. So and we'll wrap this up with these. I'll throw out 3 ideas, and we'll bring it on home. Yeah. I'll throw out a couple of ideas. Uber, I think, is a dislocated, probably high quality stock. It certainly faces really large TAMs, total addressable markets. I think the global market for ride sharing and food delivery, which they are the leader of in both categories, by the way, that's a TAM, $1 trillion plus TAM. So I think Uber can do what I call pull a Google. They can grow 20% year over year at scale for multiple years, maybe even a decade. That's what Google did. So that would be one. And the stock is, the $35. It's well over 30% off of its highs. It's trading at what I think is a trough multiple. And then another one I'll throw out is Spotify. There's a company that I write about a fair amount in the book. They've been actually exceptionally good at product innovation, founder-led company, relatively large TAM, probably $150 billion TAM, with I think a pretty compelling consumer value proposition. You mean you get any music you want, pretty much from the world's music library, on demand. That's a pretty good service. And there's been a lot of nice innovation there. And any of us who are listening to our year wrapped campaigns now probably appreciate some of the specialness about Spotify. So that's another one, dislocated, high quality. And then that last one you mentioned, or that you and I talked about a few minutes ago, Shopify, that could possibly fall into that category, Tom. That's a high quality asset. It's the question is whether it's dislocated enough, but I would at least put that into consideration of a DHQ stock.
Right. Okay. Technically down, but maybe not cheap. Certainly not cheap. And well, before we go, writing a book is wow. That's a whole other endeavor. That's a full-time job. So for a full-time analyst, what was the hardest thing about writing a book?
Well, I really enjoyed the process of it. And I think part of it was just finding the time to write it. And so I had the idea of writing a book. I'd been writing it on and off for a couple of years. Tom, you may or may not know this, but my teenage sons were starting to tease me about, hey, Dad, when's the book coming out? So I'd mentioned it, but just hadn't been able to finish it or get enough work done on it. And then I just got a 3-month stretch of time between 2 jobs. And that's what I needed. The hardest thing was finding the time to write the book. Yeah. And I was lucky. I was able to get that time and put in 5 to 8 hours a day of writing. So I guess for me, that was the hardest part. It took me although in all fairness, it probably took me a couple of years, that's a long time, to really come up with a framework I wanted. But it took me a while, and I finally figured out the framework. And then so the ideas were germinating for a while. So it was, I guess that's the answer to your question, Tom. 2 things: coming up with the framework for the book, like I knew I had a lot of thoughts, but what was the framework I was going to use? Like, what was going to be the structure of the book? I needed to come up with that. And then the second one was finding the time to write it. And I needed that constant. Maybe some people can do this, as their side job. I couldn't. I needed full-time, most important job of the day. After family, most important job of the day. I needed to be writing a book. If I was going to do it after my day job in the evenings, it wouldn't have gotten done. So those are the 2 hardest things.
And will you narrate a version of this for Audible or for Spotify?
You don't always get everything you want in life. And I'm a huge audiobook listener, and I was so looking forward to reading my book. And apparently in the contract I signed, I later discovered that it was not my decision as to who the reader was or is. So somebody else read the Audible audio book version. So in my next book, Tom, you know what I'm going to insist on in that contract?
Absolutely. So there will be an audio version then?
There is an audio version. It's available. Yeah, there is one.
Oh, all right. Well, it wasn't in November. Yeah. So for everybody tuning into this, you can see Mark every other week, I think, in the morning on CNBC, if you want to hear his most timely, freshest stock calls. But if you want to get the backbone of it and the theme and hear about, all the details, all the history, this is what you read. And, I enjoy, like I said, I think today's individual investors very much needed something like this. It's been a long time since Peter Lynch went up on Wall Street. So I'm really glad you took the time to write it.
Thanks, Tom.
And I hope everybody who has interest in stocks and growing their wealth pay attention to it.
Yeah, thanks, Tom. Thanks a ton for the opportunity to talk through it. And Tom, as always, I only wish you one thing: nothing but net.
Nothing but net. Next time we're on the basketball court. All right.
See you, buddy.
Good night.